Hello and welcome. I'm Taylor Pearson, and this is the Mutiny Podcast. This podcast is an open-ended exploration of topics relating to growing and preserving your wealth, including investing, markets, decision-making under opacity, risk, volatility, and complexity. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. And listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making such a decision on the appropriateness of such investments. Visit www.rcmam.com/disclaimer for more information. In today's episode, we talk with Alex Orus, a principal at Principalium Capital based in Zurich, Switzerland. Alex is one of the most experienced traders of the Volatility Index, often called the VIX or Fear Index, having founded Blue Diamond Capital, which began trading the VIX in 2007. In this conversation, we talk about risk and how many investors measure risk in a way that actually increases rather than decreases their risk. And we then dive into the history and structure of the VIX and its associated products and how investors might want to get exposure to the VIX to improve the overall performance of their portfolios. There were a couple of terms that Alex talked about in the interview that I just wanted to briefly introduce. Alex mentions a few times an event in February 2018. What happened was that on February 5th, 2018, the VIX went from 13 to 37, nearly a 300% move in a day, which was its largest percentage move in history, causing large losses or large gains for traders on either side of the market. And then we also talk a little bit about mean reversion. And mean reversion is just the idea that an asset moves back to its long-term average. So the VIX's long-term historical average is around 20. So if the VIX spikes to 40 and then moves back towards 20, we call that move back towards 20 mean reversion. So with that out of the way, I hope you enjoy this conversation with Alex as much as I did. So I wanted to start off and talk a little bit about risk, just broadly or generally. I know the Financial Times did a piece on you in 2011 where you talked a lot about the financial industry and how the financial industry thinks about risk and has traditionally thought about risk, particularly the Sharpe ratio, which is a measure of historical volatility. You mentioned an alternative measure that you look at a lot more called the Kalmar ratio that I'll let you expand on. But yeah, I'd love to hear you just speak sort of generally, how does the financial industry generally think about risk, and what would you how would you critique or comment on that, and maybe lead us into the Kalmar ratio and why you think that's perhaps a better measure.
Sure. Basically, a lot of the industry has been looking at risk from a perspective of price fluctuation, and they call that volatility, and they basically think that is risk. My view on it is that price fluctuation is a measure of risk, short-term risk, but much better is to look at price as being risk. So in other words, if I'm looking at, buying a house, and that house is $1 million to construct it, so the replacement value of that house is $1 million, and I buy it for $2 million, I'm paying $1 million more than the replacement cost. So to me, price and not price fluctuation is risk. So it's the fact that I basically can lose money or draw down is a better measure of risk.
Along those lines, with sometimes Kalmar, sometimes called the Mar ratio, and it's just basically your return over time divided by your max drawdown. And as you alluded to in the FT interview too, there's two things that the industry tends to do. We tend to talk about nominal returns, and we talk about like Sharpe ratio or variance, right? And it's really interesting as an individual, you shouldn't care about either of those. Those are more academic concepts where we should really care about absolute return, our returns after inflation. What can I eat at the end of the day? And then my biggest risk is actually my drawdown, because I don't want to lose money. And it's interesting how the industry has pegged to these nominal returns, and they don't even count for inflation, and then they use, like you're saying, price swings or variance as a metric for risk and not drawdown. And then I know when you founded Blue Diamond, that's what you guys were looking at more, is like, how do we maximize MAR or CalMAR ratio over time? And has your thinking evolved on that, or is that still how a metric you use for Principalium?
Yes, one of the issues by using the Sharpe ratio, which is certainly not a bad measure when you're talking about a long-only universe, basically, of equities and bonds or balanced portfolios. When you in the Sharpe ratio, basically, is based on a normal distribution of returns. When you start looking at hedge funds or alternative investments, those returns don't have a normal distribution. So they might be skewed into one direction or the other. So therefore, the use of the Sharpe ratio is certainly not that appropriate. It's much better to use the CalMAR ratio, where you look at basically the skews of your returns, because you're analyzing whether or not a manager is good also, not only going long in the market and equities or whatever, but also shorting the market. So therefore, the fact that the Sharpe ratio is based on that normal distribution, it misses the point that when you start looking at returns that are not normally distributed, it will not catch that. So therefore, the ratios that are more appropriate for looking at hedge funds are the MAR ratio or the CalMAR ratio or the Sortino ratio, which is a variation of the Sharpe ratio, but it looks at the downside volatility of your return stream. So yeah, my view has not changed. That is on the how efficient is a portfolio. Secondly, your other question alluded to what I was what I basically mentioned in the FT article a few years ago, which was having benchmarks like LIBOR. And looking at an absolute return to beat that LIBOR don't really make sense, because at the end of the day, there's no currency associated with that. And if you look at inflation, it's a much better measure to see what you basically, in real terms, what your return is in real terms. So those two comments I made a few years ago have not really changed.
And the way and this might be slightly off topic, but the way I think about it a lot of times is like, if you just take a simplified MAR ratio, like I was saying, of returns divided by drawdowns, for that to really make sense, I would like to see, like a 2-decade plus track record. And I actually reached out to a lot of people in our network trying to ask around, is like, has anybody heard of a manager that has more than 2-decade track record that's had like a MAR ratio of greater than 1 or at least equal to 1? So let's just say their return after inflation was 10% and their worst drawdown was 10%. And people really couldn't come up with anybody besides maybe Ed Thorpe, and some people said Renaissance Tech, Rentech, but I think their drawdowns have excluded them. And it's just, I wonder how like you think about that. It's like, do you need decades of track record for, MAR or CalMAR to make sense for you to feel confident in them? Or how do you, because that our worst drawdown is always ahead of us, it seems to be.
That's a good question. I mean, certainly, 95% of the times the markets are moving up, right? So we are just entering probably the 10th year of a bull market. And therefore, a lot of the managers that don't have a track record that's more than this period, or measuring a Calmar ratio, which is looking at the drawdowns, at the maximum drawdowns, is certainly requires that one looks at further time, more extended time periods in that sense going back. So this is the issue that I see in today's markets. We have been, if you look at the hedge fund industry, most of the hedge funds have made money by going long equities or going long beta, and they haven't really been tested on during the drawdowns, or have not really excelled during those drawdowns. It's clear that if you're running a hedge fund during the last 9 years, that the way to make money is by either going long equities, or what we would look at it from a volatility perspective, volatility trading perspective, we would go short vol. So the markets, the markets and the strategies and the hedge fund managers have predominantly been short vol. I do understand it, right? Because you're running a business, and that's the way you made money in the last 9 years, which is not certainly saying that going forward that can change.
You mentioned your short vol. I wanted to dive into volatility a little bit more. You've been trading the volatility index, usually abbreviated as the VIX, a lot longer than most people that are trading it today have been trading it. I was hoping you could just sort of talk us through, what exactly is the VIX. And I think most people know it's sort of like a measure of volatility, but not exactly sort of how it's constructed, and maybe some of the history there and how it became tradable. And just sort of how you look at that space.
Sure. The VIX is basically an indicator. Some people call it the VIX, the fear indicator. And it basically, it's constructed using a strip of call and put options. So basically, it shows what the current what the option market sees as being the current price of volatility. It was established in 2004. It's very important to understand that it's an indicator and it's non-tradable. It has a series of futures building a so-called term structure curve each month, reflecting what the market thinks the volatility is, the implied volatility, so the volatility looking forward, will be in 1 month, 2 months, 3 months, 4 months, and 5, 6, 7, 8 months. So that curve, when the VIX and the first contract, second contract is higher than the first contract, third one, and so on, it builds a curve that is in contango. It's what we call in contango. That means that the market players expect the future implied volatility to be much higher than the realized volatility. So 2004, this VIX was established, and the futures, the CBOE, futures exchange, the CFE, basically provided the market players with an opportunity to trade the future implied volatility.
And just maybe clarify a little bit, you mentioned like the VIX itself is a number I'm looking at. It's let's say 17 right now, and then you can't trade that this VIX specifically, but you can buy futures on the VIX. So there's 1 month futures at a VIX of 18, a VIX of 19, a VIX of 20, and those all have different prices associated with them. And sort of the normal thing is, as you go further out into the future, that the term structure slopes up because there's more uncertainty sort of going into the future. More things could happen between now and 6 months from now than now and 1 month from now. Is that an accurate summary, or how would you sort of critique that? That's
absolutely right. That's the way. That's the way it gets reflected in the curve. That as you move out, there is more and more uncertainty about things, and so I would say that the market thinks that the future volatility is going to be higher than it is today. So that's embedded in that curve, in that term structure curve, is then the risk premia, basically that you can capture and extract from this curve. So it's kind of like the insurance premia that people pay going forward in the markets.
As you alluded to, VIX futures are a relatively new product, and like we were saying, you've traded this space almost longer than anybody else. And how have you seen that change over time? Where I'm sure in the beginning you were one of the few players in the space. Liquidity was probably pretty minuscule, and then after 2008, 2009, we see liquidity start to ramp up a little bit. And then you have all the VIX ETFs and ETNs, and more players coming into the space. How have you seen the just the VIX market evolve since you've been involved?
Well, certainly, as you alluded to, volumes have increased tremendously. Also, there have been a lot of ETNs and ETF products based on the VIX futures. So that increased the liquidity of the markets. More market players went into it, and therefore, I would say first, second, and third, maybe the fourth contract have substantially increased the liquidity. The volumes have increased substantially on those contracts. The rest of the contracts are not as liquid. Still today are not as liquid. The way the market has changed, obviously, that's great to have more liquidity and more volume for trading it. But the way the basically what has changed was is the patterns are the patterns of how volatility moves. So in other words, we started in 2010 trading the VIX, and we were extracting this risk premium I was alluding before. And if nothing really happened during the month, there was on average 5% risk premium on the curve. More market players started coming into trading the same into the space, and that that increased competition has made it more difficult to extract that kind of usual 5% from the markets. But what has really changed more recently is after the elections, is that prior to that, you used to come up with a volatility used to come up with the elevator, and used to come down the stairs. So the patterns were not as technical as they are today. After the elections, and due to some of the tweets, you can have some pretty erratic moves and very short-term mean reversions of the spikes, of the volatility spikes. So the market has become much more technical. In addition to that, obviously, if you look at the underlying, you look at the algorithmic trading firms, they've basically also made markets more erratic and more technical. By technical, I mean that things move much quicker than they used to. And so they're scalping whatever alpha there is, or they're making a certain move in one or the other direction much more extenuated. So that's what's really changed, is we went from obviously being some of the first traders in extracting the risk premium to now having more market players, and also having the pattern of the VIX becoming much more shorter term, For instance, we take a February of 2018, and there within one day you see VIX jumping to 40, and on February 6, 2018, you see VIX just dropping down massively, mean reverting. So that kind of pattern wasn't there before, and so we basically have undertaken some steps, obviously, to trade very differently, much shorter term, I would say.
And that actually leads me right into a follow-on question for that, because I've heard you talk about it before, is that, like you're saying, if it's changed where it used to spike and then slowly drift down, and now it's mean reverting harder than ever, is if you're set up to capture those spikes, you need to make sure you have some sort of monetization if it's mean reverting just as rapidly. So like, how do you think about capturing that before it mean reverts on you so quickly that you can't even capture any of your profits?
That's exactly an extremely important point right now, which is we have to have trading systems or ideas that work and that take 15-minute snapshots. Whereas before, we would look at and take 3 snapshots a day, and we will position ourselves. Now you have to have part of your investment process geared towards 15-minute intervals or 5-minute intervals. So the intraday trading of these patterns are extremely important, more and more important. Obviously, the one thing you have to consider within the VIX or volatility universe is that costs, the tick size of buying a trade, a future trade, is $50. So your round trip is going to cost you $100, which means that you have to be extremely effective in the way you trade. I don't mean commissions. I mean just the tick size of these contracts are extremely large. There is a flip side to that, which is because they're large, the short-term algorithmic trading programs will have a harder time to enter into the universe and into the space. So that's a piece of good news for us.
That's actually a great way of putting it. Yeah, I was thinking about that all the time. It's like you have multiple factors on the VIX that I assume would help you out. One is like long gone are the days of rebalancing your VIX position at the close, right? And only looking at VIX at the close. Now it's the intraday. So liquidity is improved in those front month contracts, which means liquidity is improved intraday, which makes it a lot easier for you, like you're saying, to take the 15-minute snapshots. But like you said, you got that $100 round turn hurdle on just the tick size, which keeps out the high frequency traders. But it also, don't you think it also keeps out a lot of the capacity constraints? Keep out a lot of the hedge funds that are algorithmic traders or trend followers that are in the tens of billions, because the VIX space is a little more capacity constraint, so that provides another maybe alpha source to stay small and nimble. Or how do you look at that?
Absolutely, I think that's right, and that's our aim, is to manage capacity. Obviously, the VIX space has been attractive for some of your trend following CTAs. To capture just another market, as if they, an additional market, like they have their equity and other commodities, they enter into the VIX market. But as you rightly point out, the costs are prohibitive to basically do too much of that. On the other hand, you have some of the vol arbitrage. I basically started doing vol arb. Playing relative trades on the curve and extracting the risk premia. That discipline is has to be combined with some very strong technicals, and this is why I teamed up with my partner, who has a 13-year history in the CTA and algorithmic trading, combining the vol arb fundamental way of looking at the term structure curve. So that combination means that my partner brings in some of the more shorter term intraday or 15-minute interval ideas, technical factors, filters that will allow us to take very quickly a long or a short position within the market.
I wanted to zoom out for a second. Just if you're sort of talking to an investor that's vaguely familiar with the VIX, but no experience trading it. Why would an investor want to have some exposure to the VIX in their portfolio? Why would that make sense?
Well, there's been a lot of discussion whether or not volatility is an asset class. I firmly believe that it is an asset class and is a very effective way to reflect going long the market or short the market, or running some sort of carry strategy. So I can, the way I look at the universe is I can always attach a volatility long or short or neutral position to your traditional markets. For instance, going long equities is going short vol. And that is extremely effective, is very efficiently reflected in the VIX market, in the volatility market. So you can capture bear markets, for instance, and that you go long volatility. So it's just buying a contract and you're reflecting that in a very effective and efficient manner with the volatility universe, the VIX volatility universe.
Yeah, I think we talk about that a lot. I think we usually just talk about sort of in terms, very similar to what you said, just as diversification. Volatility is an asset class, and just the way you diversify across other asset classes, it makes sense to diversify across volatility as an asset class. And most investors' portfolios are overwhelmingly short volatility.
Absolutely, yeah. That's. I mean, again, you can look at the traditional universe of equities and bonds as you can look at it in terms of volatility, going short, long volatility, or being in cash. So it's a very efficient way to play that trade, and it's a very strong diversifier because it is an asset class that has a different return pattern than your traditional asset classes.
And obviously, this is your business. You do this full time, and you're looking at detail. For the retail investor that's just sort of interested in the VIX, like what are the options for getting exposure, and then maybe speak to some of how those instruments are constructed, and the advantages, disadvantages.
Well, the market came out, several providers came out with exchange-traded funds. There are several of those. There are those that basically reflect short volatility and roll over continuously. Some other products will go long volatility. Some will go this version of short volatility and leverage that up. Some will have a version that some of the ETFs will do it on the long side. Obviously, we had a few blow-ups because when you have a short ETF and you leverage that, your potential loss is unlimited. Is unlimited. You can lose 100% of your investment. For the retail investor, some of these products, and by the way, certainly going short volatility, leverage short volatility with an ETF is certainly has a certain high risk associated with it. Obviously, we spend 90% of the time in a short volatility mode, right? But when the event happens, you will lose you will lose a lot of money. Again, I want to reiterate that something similar happens, that if you're long volatility, because as I said, most of the time markets are going up, and your long volatility will have a negative decay, negative roll yield. So will cost you money and cost you money and cost you money and cost you money until that event happens, where your long ETF will basically provide you with a return. But if you look at now at the last 9 years, we have been in a bull market, so that is extremely costly. And so what is ideal, though, is to have some sort of combination dynamically moving from one to the other, or having a combination of those two. There are products in the market. I'm not sure that there are a lot of ETFs in that space, but there are some.
And that actually, thinking about the ETFs and ETNs in the space, is there's been a consistent theme on this podcast and obviously through our managers, and I think it shows our biases. But when we talk about short volatility products, it's really easy to go passive with anything short vol. You can just hit that buy button on almost any short vol trade. But when we talk about long volatility trades, we find it interesting that if you want to manage a long volatility position without bleeding to death, it takes very dynamic, active strategies, and it seems almost impossible to replicate those passively, like in an ETF or ETN space. I wonder what your thoughts are, because you have a lot more experience than we do in this. Is like, is that just part of being long vol? You're going to have dynamic strategies with people that have been in the markets for hopefully decades, and they're using, algorithms and then their discretionary overlays to have, dynamic, active strategies.
That is a good point. That is a very good point. And when we talked about what has changed in the last few years, I mentioned that the volatility moves are extremely erratic. Going to my example of February of 2018. The move is close to being intraday. So therefore, if you passively try to, or dynamically, but in a passive rebalancing mode, you try to capture that kind of event, you're way too late. This is a matter of seconds that you need to switch from one to the other. And so here is where the expertise and the algorithmic trading know-how that, for instance, someone like us bring to the table, in that we can very quickly shift that position. So it basically, the change and the much shorter it's change in volatility patterns, the more erratic moves, it leads to having to choose a strategy that can very quickly reverse its sign.
And then you're sort of continuing on with the theme of, as Jason mentioned, long volatility seems to be a space where sort of having active management makes more sense than the short volatility space. What are the sort of primary active approaches to trading the VIX? I know one is sort of pairs trading it with the S&P, where you go long VIX, long S&P, or short VIX, short S&P, or then calendar spreads, where you're trading you mentioned sort of the front and back month of the term structure. I was wondering if you could, I don't know if there's any others or other ways you think about that, but what are sort of the active approaches to trading the VIX, and then how do you sort of think about the advantages and disadvantages of each of those strategies?
Certainly, we could take the example of what you just mentioned. So you can short, for instance, the first contract, go short volatility to capture the negative roll yield or that risk premia within the term structure curve, and hedge yourself with a short S&P. That is a trade I've done in the past, and it worked quite well. That trade, it is now a crowd trade, and that what I mean with that is that basically there are sometimes decouplings between your short and the S&P. That correlation breaks down. So what you've had more recently in the recent years is that trade that the S&P has not really hedged your position. And by the way, one important thing to understand about the term structure curve and the futures that are displayed in that universe is that there's no natural hedge, right? There's no natural hedge of any of those futures. What we're trying to do is a proxy by shorting the S&P because it has on average a fairly high correlation, but that has been breaking down. So we don't do that kind of trade anymore. What we do is basically we use techniques that are much more on a term structure curve, and they'll go, short volatility with stop losses and with some pretty strong risk management, or they may hedge, but they'll have a very dynamic way of continuously hedge with the underlying market. In addition to that, also what is important is to diversify that hedge. So not only going short the S&P, but also but going also long treasuries. Because the treasury is still, when the unexpected event hits, it really is an additional long, is an additional hedge to your position. So the traditional way, as it's described now, that we were doing, we were putting the trades to extract the risk premium of the curve and hedging yourself. We don't do those anymore in that way because of the breaking down and the decoupling of sometimes of the markets with the derivatives.
And just maybe just to clarify, and correct me here if I'm wrong. As the VIX is, as you mentioned, it's a derivative of the S&P. It's calculated using option prices on the S&P 500, and so the idea of going short VIX, short S&P, or long VIX, long S&P is you're trying to find a hedge. You mentioned there's no natural hedge that's used by many people, and you mentioned you historically sort of use that as a way to protect that position in the VIX. Is that accurate?
Yes, that's accurate. There's no perfect or natural. There's no perfect hedge. Maybe natural is not the right word. There's no perfect hedge to your short futures position. What you can do, obviously, because they're related, obviously the futures are related to the options market, and the options market is related to the underlying S&P 500 futures market. There is a relationship there, but that breaks down every once in a while. So therefore, you have to hedge yourself in a much more dynamic way than you used to do in the past.
And, why is it necessary to hedge that trade? Why not just go, long VIX, short VIX?
Well, because it's you can think of it. Let's give an example. Let's say VIX is, it's been fairly low in the last few years, but let's say that VIX is at 13, okay, and the first contract is maybe. The first futures is maybe at 14 or maybe at 14 and a half. So there is some risk premium, right? There is a difference between your VIX, your spot, and your first contract. Okay, so the market thinks that going forward, there is going to be an implied risk premium that is there because people fear. So let's say that the VIX goes from that 13 to 15, 16, 17. That move is just not a few percentage points. That is a 10, 20, 30, 40, 50% move. So that means if you're short the first contract and that happens, and that's what we call that, the spike happens, you will lose 30, 40, 50, 60, 70%. So it's exponentially, your loss is exponential in that sense. And that means that if you think you're hedged and you think you have a linear hedge, and that exponential move spikes up, your hedge is diminished, is eliminated pretty quickly.
Right.
So that's why you have to have a dynamic hedge, or you also have to have all sorts of risk measure if you're short volatility. Having said that, we're on average, we're 85, 90% where, that trade makes money until it doesn't. And when it doesn't, your loss is unlimited because VIX can go anywhere. It can go to 80, as we've seen in 2008. So you can potentially lose a lot of money. The other thing that more and more too is that's one tail that is extremely risky within managing volatility. The other is what we're forgetting quite often now in the last few years is that the other tail is also quite risky. That means if you're going back to my example, if you're at 14, VIX at 14, and you jump to 25 or 30, okay, that's a huge move. That mean reversion, going back to 20 the next day or going back to whatever, 18 the next day, is also potential loss. It is not the same, it's not the same loss that you incur when you get the spike, but you have to consider that, you will lose a lot of money if you buy or go long volatility once the spike happened, and volatility mean reverses has a mean reversion the following day. So in other words, you look at February 5th of last year, and the next day, the volatility mean reverts 15%. So you have to look at both what we call the tails of those returns. But obviously much more dangerous is to go from a low volatility environment to a much higher one in a matter of minutes or days.
And then just to reiterate and clarify, so people would go, okay, if I'm short volatility and I'm capturing that volatility risk premium, I can get my face ripped off on the upside. So people would go, okay, I'll just go long volatility and capture those spikes. But the problem is those spikes come, once or twice every a decade. And so in the interim, you're losing on the, could be average of 5% a month if you were long volatility. So both sides of the trades have their trade-offs. You either bleed to death or you get your face ripped off. So that's part of the dynamic and active trading positions.
That's right. And it's just your weight, when it happens and then you go long volatility, the spike happens and you go long volatility, as you pointed out, that is just also quite risky to continue long volatility because of the mean reversion, and you can lose a lot, on the way down. So if the curve, if the curve is in backwardation, meaning that the VIX, that the first contract is below the VIX, so the VIX is higher than your first contract, that means that the curve is in backwardation. That means that the market thinks that the realized volatility now is higher than the expected volatility in the future, the implied volatility. If in a scenario, if you want to go long volatility when things are happening, you're way too late in this environment, because volatility moves at the speed of light, not only up but also down. So the point here is it's not, I would say it's the holy grail would be to basically, prior to a spike or prior to a market downturn, to already have a long volatility position, finance that somehow, so that when it happens, when the event happens, you're in with a long volatility position. You make them. The event happens. You make the money, and then you have to very quickly realize the profits or reduce your position, because that mean reversion can take place quite soon thereafter. So it's a very dynamic way of anticipating or being in early. There's some early signs of trouble, and that is when you see that the risk premia in front of the curve starts getting smaller and smaller and smaller, meaning also that your fear indicator VIX moves up. So the normal thing would be for your first position to move down as time passes and settles on the VIX. If you're in contango, if nothing happens, you're extracting that risk premia. But if you want to be in early, you have to see if that VIX, if your indicator, which is a strip of puts and calls, is moving up, that is usually a sign that there is potentially some trouble coming your way. So you have to be early. You have to make sure that you don't bleed to death when you do that kind of positioning.
You mentioned sort of term structure and contango and backwardation. Maybe I'll summarize and you can correct me where I'm mistaken. But so yeah, as you mentioned, sort of most in normal market conditions, that the term structure is in what's called contango, where as you go further out into the future, say a 1 month contract, a 2 month contract, a 3 month contract, it goes up. So to take your example of the VIX is at 13 today, the 1 month futures contracts might be at 14, the 2 month might be at 15, the 3 month might be at 16, and so on. And so if you're long, that front month, that 14, and nothing happens, you lose that bleed. That difference between the 14 and the 13 if the VIX stays at 13. At the same point, if you're short that front month, where the short the 14 when the VIX is at 13 and it goes up to 40. As Jason said, you get your face ripped off. There's a huge percentage change, and so sort of the way you're talking about it is what are the sort of the indicators, or how can you sort of look at one, hedging that position and so that you don't get burned too badly on either side, and two, sort of flipping back and forth, being long at some points and short at some points based on sort of different factors or different algorithmic indicators. Is that roughly accurate, or what would you correct?
No, I think that's accurate. So I think the mindset of at least what we do is we do want to very cautiously capture the risk premium within the curve, and not to be too greedy, because most of the investors will have as part of their portfolio a long equity portfolio, which is short vol, right? And that equates to short vol. It's pretty much a synonym of being short vol. So, our thinking is, why should we add to the long equity portfolio with being short volatility? More importantly, is to be in early with a long volatility position to hedge an event. That should be the objective, and is the objective of the program. That we do that dynamically without bleeding too much, because that's being financed by other parts of the term structure curve. But I think there is a certain discipline, and this is why we basically code things and we do things systematically, so we don't fall into the trap of being discretionary and in a moment of panic, making the wrong decisions. So, no, the hook is the objective is not to be too greedy to extract, to pay for the event or not to be too greedy when you extract the short volatility, and to be very early in before things happen. When you see there are clouds coming up when you see the clouds are coming up, you go in long volatility and try to finance that. So I think it's a combination of those two things.
Great. And, we've been talking about throughout this discussion since 2009, and even more recently, volatility has been massively mean reverting. But you've luckily been in the markets long enough through multiple business cycles. So if we read our Benoit Mandelbrot, he would say volatility clusters. So it's really not that simple. Most of the time, volatility mean reverts. Not lately, it's mean reverting even faster. But then there's going to be times when volatility clusters. So I'm wondering how you think about setting up your trading for that time when in the future we may see volatility clustering again.
Yeah, sure. That's it. That's an excellent question, because you have a lot of hedge fund managers, a lot of managers that what they do is they have some sort of forecasting mechanism. So they forecast the regime and say, well, now there's clustering. Now we're going to be in this kind of volatility regime. I have spent many years trying to forecast a volatility regime, and I've been unsuccessful. So the way I'm approaching it, or we are approaching it, is that the only way is taking the concept of long volatility, or what we call the SPY concept, or the mean reversion, or the extraction of risk premia. Those are the three concepts that we trade. To have each one of those concepts work in very short-term intervals, in medium-term intervals, and in longer-term intervals. So to give you an example, so there's three concepts, and there is 9 time intervals. Each one of those three concepts, extraction of risk premia, the spike or risk on type of trade, the long volatility, or the mean reversion, okay, the risk off type of trade, mean reverting. Each one of those has 3 sub-systems or 3 sub-buckets that are looking at different time intervals. So they will phase in if the spike continues and turns into a consecutive spike, we're going into a sell-off mode, into a risk-on mode. That concept will be extremely quickly intraday with part of it. It will continue the next day, putting on more positions, and it will continue the following day, or the following month, or the following weeks, continuing to be a risk on. At the same time, you will have a set of systems that are looking at, is there a reversal, is there a mean reversion, and is that mean reversion what I call a reversal, which is a very quick return to normal levels of volatility. So part of the mean reversion concept, we'll be looking at reversals that are basically 5-10 minutes and looking at strength of signal. Are we turning? Example again, 6th of February in the morning, right? Are we to 2018? Are we churning today? Is there a reversal today? So partially, that concept will come in with a certain portion of a certain portion of that concept will come into the market and start turning with a curve. for the normalized levels of volatility. So the only way is to diversify the concepts by time. I found, obviously there's plenty of people out there that can time the markets or can forecast the volatility regimes. I can't, because especially if you look at what we've been talking about, that volatility is, there's no way to predict how it's going to move. I cannot predict what the next tweet is going to be of Trump, right?
Right.
So and those do affect, right? If Trump tweets that he's going to get together with the Chinese and things are going to be, fine as far as the resolving a trade war, then that has an immediate effect. That tweet has an immediate effect on volatility and on the markets.
And not only, does it have an effect in that, like you're saying, most likely a spike, but then it has the effect of the hardcore mean reversion that you've seen too, because the news gets rapidly out of the market as well. Absolutely.
And this is why, I basically came together with my partner last year, who has the experience, the technical experience and the algorithmic experience to really very quickly reverse that trade. And just making sure, that there's a robustness of signal, that the thing is really changing direction, right? So there's all sorts of techniques, sophisticated techniques that the algorithmic trading, the CTA trend following type of guys have. And I didn't have that, if you asked me at the beginning of our conversation, did we have that in 2010? No, we didn't have it, right? Because the thing didn't move. There wasn't a tweet, right?
Right.
So now we have these things, and that's the reality of things, that the markets move much, much quicker than they used to.
You just made me think about it in a new way. It's like, obviously, Trump is the paradigmatic example with his tweets. But what you're really saying is, like, this is the world we live in now. It's a, as the internet has come of age and social media has come of age, like you're saying, the markets move so quickly in a global sense. It's not just Trump. So it doesn't matter where your politics are. It's just admitting that, news cascades through the system so rapidly that we're in a new paradigm, for lack of a better term, of how volatility can spike and mean revert due to the internet and social media age, which is a very interesting way of thinking about it. But just to recap real quickly, I like the way you were talking about it, is you look at it as three buckets or three trading styles, whether you're extracting that volatility risk premium, you have another strategy to capture the spikes, another strategy to capture the mean reversion. And at the risk of oversimplification, if we had volatility cluster for 6, 12, 18, 24 months, wouldn't most likely the volatility risk premium strategy would do exceedingly well in that environment, don't you think?
Absolutely. Yeah. I mean, it's if we go sideways, nothing happens, then certainly yes. It's become a much crowded trade. It's become a crowded trade because there's more market players extracting the same idea, but it's still a trade. Yes, that would certainly be the case.
But do you? Well, also, do you? It
doesn't really. Yeah, sorry.
I was just going to say, when you think it would become, if you have that spike to the volatility cluster, you would actually get rid of a lot of those market participants, so it become a less crowded trade because they'd be so fearful of that spike in mean reversion. So once volatility clusters, the likelihood of most of them still being there is likely becomes. That's what makes it an uncrowded trade. Or am I looking at that wrong?
Yeah. I mean, what was very interesting about last year about the trade we were mentioning in February was that because one is, has a, early on a convex position, you're a liquidity provider because you're long volatility, and the market is struggling because it's trying to sell its short volatility. So you become a liquidity provider in that sense. Perhaps one of the things that is very important, not only the clustering, but what is extremely difficult to manage at the same time is this back and forth of volatility. So I go back to May of this year, right, where you go back and forth, but not only do you go back and forth, the market drops by about 6%, and your volatility doesn't really spike. It remains at certain levels. So there's all sorts of strange unseen moves of volatility in the past. What is difficult for us as managers is really the back and forth and the whipsaw of the markets. And the way we are trying to manage that part is by you need to have strategies that are in different time intervals. That smoothes somehow your return. The other thing that you can do is doing things off the curve, where your tick costs that we mentioned before of $50 within the tick cost of your future is much lower if you trade the S&P back and forth. So the same behavior, obviously, as you see in the market, is reflected in the underlying market, is reflected in the curve. The problem of the curve is, or the challenge of the curve is the cost of trading that whiplash and that back and forth. So you do both. You try to mitigate and have some strategies that work on the back and forth of the curve, but you also have some strategies that work on the underlying market, which is much cheaper to trade. But that is a challenge. That is a challenge. This back and forth, having a lot of months where this back and forth, it makes sense to me, right? If I put on my fundamental hat on, we have created the largest bubble in history on the fixed income side, right? And obviously, the equity markets have had 9 years of bull market. So you have the two major asset classes which are richly priced, to say the least, right? So I can see that a lot of the macro players, macro managers, hedge fund managers, this is a difficult time for them, because we're in a fairly directionless type of environment. Are we going to continue to drop interest rates in the U.S., or are we going to normalize interest rates in the U.S.? So that's all reflected in volatility, in that you get this back and forth. So it's not only the clustering, but it's also this back and forth, erratic moves, which happen much shorter term than in the past.
Well, Alex, this has been really helpful. Great conversation. We appreciate your time, and we'll have to do this again sometime.
Wonderful. It's been a pleasure.
Thanks for listening. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com, or better yet, drop us a message. I am Taylor@mutinyfund.com, and Jason is Jason@mutinyfund.com, and we'll get back to you. You can find us on Twitter @mutinyfund, and I am @Taylor Pearson, ME.